Okay, everybody. Welcome to the podcast this weekend. We have some connectivity issues going on down in Virginia, so I'm going to record the podcast this weekend and we'll get it out to you guys. So, TSP Weekly Podcast, 10 August 2025. We're going to take a look at what happened this week with the economic data, the effect of Friday's jobs report. So that's last Friday, not today's Friday. We'll take a look at what is a bull trap. There's been a lot of talk about that this week because we're not back at new all-time highs yet, and been some conversation about what is a bull trap. So we'll take a look at that. The bonus chart is going to be semiconductors, and we'll take a look at the TSP Fund charts. Okay, so on Monday we had another 3-month bond auction closed at 4.165% versus 4.235% last week. So again, the lower we can sell bonds, the lower that percentage interest rate is, the less we are borrowing to increase the deficit. So you want that, right? 4.165 is less than 4.235. So that is a positive, okay? The 6-month auction also closed at 3.98. which is great compared to the last week's 4.12. Big improvements there. Okay, S&P was up 1.47%. That was after having been down quite a bit the Friday before also. Then on Tuesday, we get the 1-year bond. Also is a better price, right? 3.76% versus 3.92 last week. You get the 3-year bond at 3.669 versus 3.891. So it's looking good. We're going in the right direction as far as bond sales go this year. Volume's been low, which is not great, but the price has been getting better. S&P Composite PMI. So the composite index is the combination of manufacturing and services. And anything above 50 is the economy is expanding. Anything below 50, the economy is contracting. So this is what it looked like. So S&P Global Composite Index rose to 55.1 in July, surpassing both the preliminary estimate and June's reading. So the latest figure signals a robust monthly expansion in business activity, marking the fastest pace of growth since December 2024, primarily driven by the services sector, but the manufacturing sector output increased just at a lower rate than the services side did. So all very good news, right? New orders pick up, grew at a quicker pace, supported by a modest rise in employment, which is good. On the inflation front, I thought this was an interesting way to word this. On the inflation front, selling prices climbed at the fastest rate since August 2022, reflecting stronger demand pressures. So if there's more demand, that's a good thing. Inflation because of demand is much better than them saying it's inflation because of tariffs. Okay, so all in all, a big move to the upside in expansion of the economy, both the composites, so both the services side and the manufacturing side. S&P on Tuesday was down about 0.5%. Wednesday, we get 30-year mortgage rate dropped a little bit to 6.77% from 6.83% last week. New mortgage applications rose 3.1 after having fallen 3.8% last week. 10-year bond auction, again, better than last week, 4.255% versus 4.362%. S&P was up 0.73% on Wednesday. Thursday, we get initial jobless claims, comes in at 226,000 versus 219,000 last month. So a little bit of uptick on initial jobless claims. Continuing claims ticked up also a little bit to 1974 versus 1936 last month. But the 4-week average fell a little bit, right? The 4-week average is really the most important thing. Fell a little bit, 220.7 thousand from 221.25 thousand last month. 30-year bond auction, again, better, which is good because that's the long bond. That's the bond that's going to affect mortgage rates. Closed at 4.831 versus 4.889 previously. And the S&P was down, basically flat, but down 0.08% on Thursday. Friday, very little economic data coming out. Nothing that should really affect the market on Friday. Okay, so last Friday we had a really important jobs report, and it came out a couple days after the Fed meeting. So non-farm payrolls rose by 73,000 in July. Okay, it was way below expectations of 110,000. The June figure and the May and the June figure, but the June figure was revised sharply downward. Initially, they said that the country created 147,000 jobs, but it was revised down to only 14,000. And then May's was also revised down by 125,000. Okay, so taken together, the revisions show that employment in May and June was 258,000 fewer jobs than they had reported. So that's suggesting the labor market may be cooling more rapidly than initially expected. Okay, so this basic uptrend should have been, as was reported the last 2 months, should have been basically flat, which wouldn't have been a problem. But the revisions took the number way down, and then of course this number now is in question. Okay, so the initial response. Well, we're going to get to that in a second. Okay. So what was the impact, right? Hiring slowed sharply. Okay, the economy added only 73,000 jobs in July, way below the expectations of around 100,000, and it was a major deceleration from June's numbers that had been reported. It wasn't so much a deceleration from the revised numbers. The market reacted strongly on Friday, right? Wall Street tumbles, sharp sell-off driven by fears that slower hiring could prompt the Fed to cut interest rates sooner. Okay, so that means bad news is bad news, right? If the fear is that the Fed is going to start cutting rates because the economy is starting to fall because we're going into a period of slower hiring, that is the market responding to actual fear. But then by Monday, the fears were replaced by exuberance over the idea that the Fed is going to cut rates in September, and therefore that's a positive for the stock market, right? So that's bad news is good news. And that took over the weekend to flip. The odds of a rate cut in March were like 30% on the Thursday before the jobs report. And then after the jobs report, the odds of a September rate cut went up to like 85, 90%. And the S&P on Friday was down 1.6% on fear means fear. But then by Monday, it had recovered most of those losses because it flipped, right, to investors being excited now that if the Fed cuts rates, that's good for the market. Again, very, very difficult to try to make sense of what the market's thinking and which way the indexes are going to go based on the news. Fed officials expressed alarm. So this is, again, from Friday's jobs report. Federal Reserve Governor Lisa Cook stated that the tepid jobs growth and notable downward revisions in past data point to economic turning points, signaling potential risks ahead. Okay, investor sentiment rebounded. The market recovered somewhat early this week, but a lot of that, well, it was based both on positive earnings in Palantir, DuPont, Apple, and McDonald's, but it was also based on this idea that the Fed is going to cut rates, which is good for stocks. So all that creates a lot of volatility, which we've been seeing over the past 2 weeks. And then, of course, there was a political fallout, right? The BLS commissioner was fired. So President Trump, citing the weak report and without evidence, accused BLS leadership of rigging data and fires the BLS commissioner. There's concerns now over BLS integrity. So experts emphasize that the real issue at the BLS are long-standing, that underfunding, outdated data collection methods, and falling participation in surveys rather than any political manipulation. So they're saying that the problems existed over time at BLS. It wasn't a political manipulation. and politicization of labor data. So commentators warn that targeting the BLS risks undermining trust in critical economic indicators, potentially damaging policymaking and markets. The firing has drawn sharp criticism for politicizing an independent agency. So what I thought was interesting was Ray Dalio's take on it. According to reporting from Reuters, Dalio stated that he probably would have fired the head of BLS too, right? Referring to the BLS commissioner. His reasoning, though, he believes that the Bureau's methodology for estimating employment data is obsolete and error-prone, especially highlighted by the abrupt and large revisions prior to the job numbers. So he went on to urge that, hopefully President Trump clears up his motivations for the firing, warning that data manipulation for political ends could undermine trust in economic statistics. So that's the big problem, right? It would be great if somebody from the administration came out and said, hey, the way that BLS collects data is antiquated. There are better ways to do it. Trueflation.com is a really good website. If you guys haven't been to that, it's a good one. It's about inflation. But they use actual data rather than surveys. There are a lot better ways at this point, given the technology that we have, to come up with this information. And so it would be much better if the administration said that we're going to revise the way BLS does things rather than claiming it's political rigging. Okay, so what is a bull trap? So a bull trap is a false signal referring to a decline in a stock, index, or other security that reverses after a convincing rally and breaks a prior support level. The move traps traders or investors that acted on the buy signal and generates losses on resulting long positions. A bull trap may also refer to a whipsaw pattern. Okay, that's from Investopedia. So this is also from Investopedia. Bull trap occurs when a trader or investor buys a security that breaks out above a resistance level, right? We talk about that all the time. It's a common technical analysis-based strategy. While many breakouts are followed by strong moves higher, the security may quickly reverse direction. These are known as bull traps because traders who bought the breakout are trapped in the trade, right? Unless they get out of it, because nobody wants to sell a trade that rolls over immediately. So they feel like they're stuck. That's the trap. So traders can avoid bull traps by looking for confirmations following a breakout. For example, a trader may look for higher than average volume and bullish candlesticks following a breakout to confirm that price is likely to move higher. A breakout that generates low volume and indecisive candles, such as the Doji Star, could be a sign of a bull trap. So why are we talking about this right now? This is the worry about a bull trap. Okay, we had 1, 2, 3 days of basically flat at that 6,400 level. Okay, and it came on, pretty big volume down days. Okay, that's institutional selling, right? That's big money getting out at the top. And then the jobs report, the market gaps down, right? Again, on not as big a volume as the day before, but pretty big volume. Relative strength turns way down, and MACD had already been, right? So momentum had already been weak. So the worry is that this recovery that we've seen this week is happening on pretty low volume, right? Lower than average. And relative strength is not really picking up, and MACD is not getting stronger. So we are still in the potential of a bull trap. If we need to get above this high, right? It's a little bit above 6,400, because right now 6,400 is definitely significant upside resistance, right? So that would be kind of as opposed to this breakout back here, right? We gapped up and got confirmation the next day because the market kept moving higher, and it was doing it on big volume. And we also had improving relative strength, and MACD was improving. So this kind of picture on that breakout is bullish. This picture on this breakout is not bullish. Okay? It doesn't mean the market's going to roll over. It's just the condition that's existing right now. Okay. All right, so bonus chart is semiconductors. Why semiconductors? Semiconductors are the foundation to modern technology. Okay, they're the building blocks for integrated circuits, microchips, microprocessors, all essential for virtually all electronic devices. They're vital for communication technologies, powering smartphones, internet infrastructure, and satellite systems. Semiconductors are essential for developing AI algorithms and hardware, powering advancements in machine learning and data analytics. Semiconductors are considered a strategic asset, right? Global competition exists between major players, US, China, EU, for semiconductor manufacturing and innovation. Supply chain disruptions during global crises, like we've seen, have highlighted the importance of secure and reliable semiconductor supply. Semiconductors are vital for the development of cutting-edge technologies like quantum computing, which relies on unique properties of semiconductors and complex calculations. Also, the Internet of Things, right, relies heavily on semiconductors for connecting devices and enabling smart home technologies, wearables, and industrial automation. So basically everything that makes the tech world that we live in runs on semiconductors. And so if we take a look at a chart of semiconductors, you can see the AI boom, right? Late 2023 was the beginning, this breakout right here on semiconductors. This was the huge initial AI boom, right? Semiconductors price went way up. It was down here at 140, right? And it got up to 280, so basically doubles. Then we had about a year. We went into a pretty good ABC correction for about a year, and finally got back above the prior high right there in July of this year. But then semiconductors have been going flat. Okay, relative strength is still pretty good. MACD is starting to turn down. This is a weekly chart, so it's a little bit more significant than the daily chart. We definitely want to see this be some kind of bull flag, right? We don't want to see, and as you can see, the wicks on the week take price down to that 280 level. That's where support is right now, okay? We want to see price stay above that 280 level and then break out to the upside. Because if semiconductors roll over, that is bad news for the AI trade, Microsoft, Meta, all the big tech companies. So definitely something to keep your eye on. Okay, TSP Fund charts. So on a weekly basis, we had a pretty good scare last week, right? We got a candle that absorbed the prior several weeks of price movement. And then this week, it's in the middle, right? Price is up for the week, right? We're up 1.64% as of Thursday's close, but it's sort of non-committal, right? We're not back up to new highs. It didn't break anywhere near new lows. There wasn't a whole lot of volatility for the week. It was a relatively slow week. It's just churning. Relative strength had dipped last week. It's coming back up a little bit this week, but from the longer term perspective, price has moved way up, and relative strength really peaked back here and has been declining all the way. So this, section of the bull market that we're in is a lot weaker than this section of the bull market. Okay, so it's beginning to fade. S Fund is weaker, right? Because we have not taken out the prior high. We had a scare last week, kind of a consolidation, nothing really happening this week, and relative strength, right, is not looking great. It's pretty significantly below the relative strength from the high, which is okay because price is still below it. So we don't really have divergence between price and relative strength on the S Fund, but it's just not looking super strong. But we are, well above that 20-week moving average line, just like we are on the C fund. And so as long as we're above that 20-week moving average line and relative strength is above 50, we're in pretty good shape. I fund continues to do pretty well. It's holding up over the past month or so, probably better than the C and the I funds. Churning, right? Consolidation there. Not as weak on relative strength in the I fund. So we would basically be looking for a breakout to the upside or a breakdown to the downside. We're just kind of churning sideways right now in the I fund. If we continue to churn sideways and the 20-week moving average line catches up, that will be a great place to find support and have the next leg higher. If it breaks down through that 20-week moving average line, we'll talk about that when we get to it. And the F fund, so we're going to talk about this a little bit. The F fund had a pretty good week last week, right? Because on Friday, there was a big scare. Everything tanked, and investors fled to the safety of bonds, which gave the F fund a big uptick last week, and it got above this high. So the F fund on this chart is in a bit of a breakout, okay? So what I wanted to point out is these are the actual F fund numbers. So if you went to tsp.gov, these are the actual numbers of the F fund. So as of Thursday's close, it was 20.38, right? $20.38 per share on the F fund. The way TSP, the way it works in TSP is there are dividends, and dividends get reinvested back into the funds. There are dividends on the stock funds as well as the F fund. The difference is, and I'm going to do a blog post about this in the next week or two. The difference is that the yield on the F fund is almost 4%. The yield on the C fund, for example, is just a little bit above 1%. So the effect of the angle of price, because of dividends, 4% dividend is pretty good. It's going to make the actual price of the F fund go up versus what the index that it tracks does. So this is the aggregate bond index. The goal of the F fund on a daily basis is to track the percentage move up or down of the aggregate bond index. So when you look at this chart, it looks like the price of the aggregate bond index has been flat, right? Going back to 2022. And that's true, right? This is what the price has done. This does not include the dividends. So dividends are not reinvested on the actual price of the index. So that's the disparity, right? So if you are a bondholder, right, you're in the F fund, while the price is going sideways, you're getting 4% a year, divided by 12, right? Because they're putting it in monthly. But you're getting the cumulative value of that dividend going into the F fund, which is why the F fund chart is going up, right? But the actual index is flat. Okay, so that's the distinction. If you're looking at it in TradingView, this is non-dividend adjusted. This is the dividend adjusted chart in TradingView. And it shows the same thing, right? We had tops there and a breakout last week. So I'm gonna do a blog post about it in the next week or two. But that's the distinction when you're trying to understand why it looks like bonds have been flat for a long time, but the I fund continues up. It's because the dividend that's being reinvested is pretty significant at 4%. Okay, and then the G fund continues to go up and to the right. All right, that is all I got. If you guys have questions, please post them in the comments and we'll get to them. It's going to be another pretty exciting week next week coming up. The questions are going to start being, does the Fed look at cutting rates before the September Fed meeting? It's not all that unusual that the Fed could cut rates in between meetings. It's certainly been done before. If there's going to be another couple of inflation reports and another jobs report before the next Fed meeting. So if those really break down, it's entirely possible that the Fed cuts rates. While ordinarily the Fed cutting rates is a positive for stocks, if they're cutting rates because the economy is falling off a cliff, that's bad news is bad news. That would be good for the F fund probably, but bad for the stock funds. So it could be a pretty exciting next couple of weeks coming up. All right, that is all I got. If you guys have questions, please post them in the comments. We'll get to them. Have a great week.